Welcome to the deep dive. We take stacks of incredible sources and pull out the key nuggets for you. Today, we're plunging into Edward Chancellor's really seminal work, Devil Take the Hindmost. Our mission, well, it's to give you a shortcut, basically, a shortcut to understanding the relentless cycles of speculative manias. Why we humans, keep making the same mistakes, and what surprising links connect centuries of financial booms and busts.
That's right. And it's a fascinating lens, not just for history, but for looking at today's investment world, too. Chancellor frames speculation in a really interesting way. It's not just greed, he says. It's deeply human, driven by wanting freedom, maybe even a kind of equality. But as history shows, these cycles, these soaring prices, they almost always end badly, abruptly. Reminds you how volatile those dreams can be. We'll dig into these collective delusions, tulips in the 1600s, junk bonds in the 1900s. The threads are surprisingly similar.
Okay, let's unpack that. Chancellor goes way, way back. What are those fundamental human things he points to? The fuel for all this speculation.
Well, he argues it's really basic stuff. The desire to trade, to swap things, and crucially, trying to predict the future. It's just ingrained in us. And the roots go back surprisingly far. Ancient Rome, 2nd century BC.
Really?
Oh, yeah. Their financial system was pretty sophisticated for the time. Markets for property, money lending, even early kinds of insurance, and speculative trading, right there at the forum. Shares, commodities.
Wow. So a lot like modern capitalism in some ways.
It definitely had echoes of it, yeah. The seeds were there.
But then things changed in the medieval period. Sounds like it slowed down.
It did, quite a bit. The feudal system, plus this strong idea of a just price, came back. Usury lending money at interest was condemned. Speculation was seen as, well, morally wrong. But, finance never completely disappears. Italian city-states started bringing back tradable government debt, bit by bit, setting the stage.
Okay, and here's where it gets wild, right? The Dutch Republic, early 17th century, they become huge players. What were their markets like?
Yeah, Amsterdam just exploded. It became the hub for speculation. They were already using complex tools. Futures.
Right, buying or selling something later at a fixed price.
Exactly. And options, other derivatives, things whose value depends on something else. There's this amazing book from the time, Confusion de Confusiones, by José Penso de la Vega. It paints this picture of just chaos, speculators acting on whims, totally irrational, honestly. Not that different from today's exchanges sometimes.
Which brings us, of course, to Tulip Mania, 1630s. It's almost the poster child for bubbles. What's Chancellor's fresh take on it?
It is the classic example, but he digs deeper. It wasn't just about a flower, you see. Prices went absolutely vertical, yeah. Parabolic. But why? Not because tulips were suddenly worth that much intrinsically. It was because ordinary people, not just the elite, suddenly jumped in.
Ah, so it was the democratization aspect.
Oh, it was the democratization aspect. Precisely. When everyone can suddenly play, it creates this emotional wave, this contagion. It wasn't just about money. It was about hope. Quick riches, moving up in the world. The crash, though. Catastrophic. Mostly for the lower classes who'd bet the farm, literally sometimes, mortgaged their homes.
Ooh.
Yeah. And it led to this deep societal distrust of speculation. Tulips became symbols of pure folly. Like that old Latin saying, homo bulla est, man is a bubble.
It really makes you think, that little voice saying, this is too good to be true.
Right. Chancellor shows how easily we just ignore it when everyone else is caught up in the excitement.
Okay, so from Dutch tulips, let's hop across the North Sea. England, 1690s, stock jobbing in Change Alley. What's going on there?
It sounds incredibly modern, actually. The behaviors, even the language they used. Trading wasn't formal yet. It was happening in coffee houses like this place called Change Alley. Very bustling. And this is happening alongside England's financial revolution. Big changes.
Like the Bank of England.
Exactly. The Bank of England gets set up, new ways to use credit emerge, and all that just poured fuel on the speculative fire.
So this culture starts taking hold these moneyed men, self-interested, and maybe even seeing greed as good for growth.
That's a really key point Chancellor makes. Avarice started to be seen almost as an engine for the economy. Joint stock companies took off, sometimes driven by things like Captain Phipps finding sunken treasure, real excitement.
Wow.
And the tools got more sophisticated. Options, futures show up in England too, hedging, outright stock manipulation. Market volatility goes way up. Even the government got in on it with lotteries. It all fed this culture of speculation. Sounds familiar, right?
Very familiar. And then the bubble burst, late 1690s.
Predictably, yes. Exposed a lot of fraud, led to some early attempts at regulation. But it just highlights the same old story. Greed, risk-taking, then crash.
Which sets the stage perfectly for the next big one. The never-to-be-forgot or forgiven South Sea Scheme. The 1720s. What was this company? Why did the stock go nuts?
Right. The South Sea Company, set up in 1711. The big idea was they'd take over a chunk of government debt. In exchange, they got a monopoly on trade with Spanish colonies in South America. Sounds good, right?
And a caper, maybe?
Exactly. The real plan, though, was less about trade and more about finance. Convert that government debt into company shares, then hype the shares to the moon. And it worked. For a while, it became this massive speculative mania. The stock price shot up like a rocket, fueled by rumors, total excitement in those coffee houses again, and now the newspapers were playing a role too.
Even though the actual company wasn't making money from trade.
Barely any. It was almost entirely built on hype and, frankly, manipulation.
And it wasn't just small investors. The elite, politicians, they were all in.
Oh, absolutely. Key figures jumped in,
Wow.
partly greed, sure, but also fear of missing out. Seeing neighbors get rich, huge social pressure that just drove demand higher, created this unstoppable snowball.
Did the government try to stop it?
They tried, kind of weakly, but regulation was basically non-existent, which just encouraged more recklessness when it burst. Widespread financial ruin, just devastating.
Chancellor uses that quote from Sir Robert Walpole, right?
Oh.
About human stupidity.
Yes, it's brutal. There must certainly be a vast fund of stupidity in human nature, else men would not be caught as they are 1,000 times over by the same snare. And while they yet remember their past misfortunes, go on to court and encourage the causes. It's pretty damning.
And the fallout led to real changes. Legislation.
It did. The Bubble Act came out of it. Made it much harder to start companies without Parliament's okay.
Right.
It's that pattern again. Society gets disgusted with speculation, passes laws, but only after the disaster.
The pattern just keeps going into the 19th century. Let's talk about fool's gold, the emerging markets of the 1820s. That story about Poyet is unbelievable.
It really is. This guy, Sir Gregor MacGregor, shows up in London, claims he's the prince, the cacique of this place called Poyet in Honduras.
Prince, seriously.
Totally serious. Says it's rich, fertile land. He floats a huge loan, £600,000, offering 6% interest. Sells land, military titles. Sends colonists out there, and they find nothing. A swamp, basically. Uninhabitable. It was a tragedy. People died. Just a stark warning about believing impossible promises, especially in far-off emerging markets you know nothing about.
Yet, even after that, investors kept pouring money into foreign ventures. South America.
It's incredible, isn't it? But yeah, Latin American countries were gaining independence, lots of excitement, investors saw high returns, so huge loans flowed out. Loans for the Greek War of Independence, too. Then came a South American mining mania, promoters making crazy claims about gold, silver, and back home, tons of questionable companies popping up.
Did the government step in this time?
Not really. Still very hands-off. They let the speculation run wild.
Until the crash.
Until the inevitable crash. Early 1825, confidence just evaporates. Companies go bankrupt left and right, big financial panic, credit dries up, banks fail, widespread economic pain, including the first Latin American debt crisis. It just shows how much markets can be driven by pure optimism, ignoring all the real risks.
Okay, fast forward a couple of decades, 1845.
Yeah.
Already communication, the railway mania. How does speculation interact with real innovation here?
Yeah, this is interesting. Chancellor suggests speculation often kind of leads the way for big innovations, takes the early risks. Then once the tech proves itself, investment gets more cautious, focuses on safety. We saw it earlier with canals, the canal mania in the 1790s. That peaked, then crashed. Railways were the next huge thing, genuinely transformative.
But people were skeptical at first.
Oh yeah, until Queen Victoria took a train trip in 1842, that gave it the royal seal of approval. Public interest just exploded. Speculative fever took off.
And the railway king, George Hudson, he was right in the middle of it.
Hudson was a master promoter and manipulator. He built this huge railway empire through mergers, whipping up public excitement. But his methods were shady, lots of secrecy, dodgy accounting, cutting corners on safety to boost profits.
Sounds like a recipe for disaster. Did the government try regulating this mania?
They tried. The Railway Act of 1844 was supposed to bring some order, but it got watered down. Politics, that laissez-faire attitude, it didn't do enough. So the mania just got crazier. Tons of railway projects, huge investments, very little real oversight.
And investors just piling in.
Piling in. These guys called railway stags were just buying and flipping shares, inflating prices, lots of outright fraud too. The government kind of let it run. Then, starting October 1845, crises hit, share prices collapsed. huge losses, another wider economic crisis.
It really raises that question again, doesn't it? How do you balance encouraging innovation with preventing total meltdown?
It's the perennial question. There's never an easy answer.
Okay, let's cross the pond. America, the Gilded Age.
Chancellor says speculation went from a sentiment to a master passion there. That's his phrase, yeah. He paints the stock market almost like this seductive monster, dangling gold prizes people can't really reach. And, the American spirit, that risk-taking element, plus the sheer opportunity. It fueled massive speculation. Land, infrastructure, even guys like George Washington, Thomas Jefferson, they were involved in land speculation early on.
And the Civil War just accelerated things.
Oh, massively.
Yeah.
Despite the uncertainty, maybe because of it. Inflation, war contracts, it created this hothouse environment, perfect for manipulators. Guys like Daniel Drew, famous for his tricks with Erie Railroad stock, Cornelius Vanderbilt, ruthless. And then you have Jay Gould and James Fisk. Their attempt to corner the gold market led to Black Friday, September 1869, just total chaos.
But even after that, the speculation just kept going.
Pretty much. The tactics were out there, new exchanges were popping up. The game just continued.
Which leads us, inevitably, to 1929, the end of a new era, the crash of 1929. That quote from Irving Fisher, permanently high plateau, right before the floor fell out.
The ultimate, this time it's different moment, isn't it? And Chancellor points out that new era thinking, it wasn't new even then. It popped up in earlier bubbles, too. People genuinely believed the old economic cycles were gone, finished.
Why? Was it the Federal Reserve?
That was a big part of it. The Fed was created in 1913, supposed to bring stability, manage crises, control interest rates. Ironically, that feeling of safety probably encouraged more risk-taking. Plus, this cult of common stock developed. Books like Edgar Lawrence Smith's argue stocks weren't risky gambles, they were safe long-term investments.
So prices just got completely detached from reality.
Totally detached, based on wildly optimistic ideas about the future.
And margin loans played a big part. Borrowing to buy stocks.
A huge, huge part. Wealthy people did it, amplified their bets, but also regular consumers were borrowing more than ever. Installment plans. Everyone was borrowing against future earnings, assuming the good times would just keep rolling.
Brokerages were pushing stocks hard.
Aggressively, expanding everywhere. And market manipulation was rampant. These organized pools would work together to drive up prices, then dump them. The stock market became cool. Celebrities got involved, ordinary folks, women started investing heavily too. It was a cultural phenomenon.
So the warning signs were there, but people ignored them.
Pretty much. Some people at the Fed were worried, a few economists raised flags, but the general belief in endless prosperity just drowned them out. Then came Black Thursday, October 24th, massive selling. Then the big one, Black Tuesday, October 29th. Catastrophe.
Hoover tried to calm things down.
Yeah. But it was too late. The country plunged into the Great Depression.
What's the biggest lesson from that whole era?
Well, it shattered illusions about the stock market, showed just how dangerous these bubbles are, and it led to massive changes. Glass-Steagall, separating regular banking from investment banking. The SEC, the Securities Exchange Commission, created to regulate markets. A fundamental rethink of Wall Street and government's role.
Okay, moving into the post-World War II era. Chancellor calls it cowboy capitalism. How did Bretton Woods try to put the brakes on speculation initially?
Right, Bretton Woods, 1944, set up this whole new system. Currencies fixed to the dollar, dollar fixed to gold. A key goal was to stop speculative money sloshing around the globe. Speculators were seen as bad guys then, almost like black marketeers during the war. And that view lasted for quite a while, into the 70s.
But it didn't stick. Nixon taking the U.S. off the gold standard in '71, that was huge.
Absolutely huge. Chancellor calls it the second financial revolution. Currencies started floating against each other. Speculation suddenly had a much bigger role to play. Money became more abstract. Walter Reston at Citicorp had that great line, information became as important as money itself. Very prescient.
And technology started playing a bigger role, too.
Definitely. Electronic trading, faster information.
That's it.
It opened the doors for more people to trade faster. Day trading started to become a thing, especially with the internet later on.
But interestingly, Milton Friedman, the big economist, he defended speculation around this time.
He did. His ideas, monetarism, were kind of a throwback to 19th century thinking. He argued speculation was vital, said it helped markets work efficiently, prevented shortages, allocated resources, and academia was buying into the efficient market hypothesis, the idea that markets are rational, they price everything correctly on their own.
So when deregulation really took off under Reagan, what happened?
It was like opening the floodgates. Derivatives just exploded, all sorts of complex new financial products. The whole political mood shifted too. Deregulation was good, making money was good. The trader became this heroic figure. Professional traders started using really aggressive, high-risk strategies in this less regulated world.
Which brings us right to Michael Milken and junk bonds.
Exactly. Milken was the icon of this era. He pioneered using jump bonds, these high-risk, high-yield bonds, to finance leveraged buyouts, LBOs.
Taking over companies using mostly borrowed money.
Right. He made incredible amounts of money, changed corporate finance, made taking on huge debt seem normal, even smart. But the risks were enormous. It all came crashing down eventually. Milken went to jail. And the savings and loan crisis around the same time. That was another perfect example of reckless speculation fueled by deregulation.
Okay, one last big bubble from the book. Kamikaze capitalism. The Japanese bubble economy of the 1980s. What made Japan's situation different?
This chapter is really interesting. Chancellor talks about Nihon Jinron, this idea of Japanese uniqueness. More focus on the group, on authority, less on Western-style individualism. Even as Japan modernized, that hierarchical group loyalty thing persisted. Loyalty to the big companies, the zaibatsu, the keiretsu.
Seems like that wouldn't fit with wild speculation.
You'd think so. But then Japan liberalized its financial markets in the early 80s, and this practice called zaitech took off. Basically, companies started making more money playing financial markets, stocks, real estate, than from their actual businesses. It became this huge bubble. Companies, banks, everyone speculating like crazy. They felt invincible.
What fueled it specifically?
Things like the Plaza Accord Agreement. That made the yen skyrocket in value, which inflated the price of assets within Japan land, stocks. But the crucial point Chancellor makes is about the government's response when it burst. They tried to manage the decline, prop things up, didn't really let the market clear itself out.
Why is that significant?
Because it fostered this belief, maybe subconscious, that the government would always bid all things out, that investors didn't really bear the ultimate risk, and that's incredibly dangerous.
So wrapping this all up, what's the big takeaway from Chancellor's journey through centuries of bubbles? From Rome to Tokyo, it seems like the same human failings, hope, greed, that this time it's different, delusion, just drive these cycles over and over. And the rules, the regulations, they always seem to come after the crash, not before.
It's uncanny, isn't it? The psychology is just so consistent, even when the technology, the economy, the culture are totally different. The lessons are pretty blunt, really. You need critical thinking. You need skepticism. You need to do your homework, due diligence. Still absolutely vital for anyone in the markets.
So here's the final thought for you listening. Given this long, often painful history, this unchanging human psychology, how do you tell the difference? How do you spot genuine, game-changing innovation versus just another speculative frenzy in today's super-fast markets? How do we apply these timeless lessons when the world keeps throwing new eras at us? Something to chew on as you continue your own deep dive.